What does today's stock market rally have to do with England and more specifically, the Bank of England? Let's talk about that a little bit further. The issue really starts with the UK's new Prime Minister, who basically made promises of spurring economic growth through government reform. This government reform would take the form of energy subsidies as well as tax cuts. Her finance minister last week doubled down on some of these government reforms by talking about increases in tax cuts. The markets, however, viewed these programs as effectively being inflationary, meaning really that the Bank of England would now have to increase interest rates even higher in order to combat inflation. Very similar to what the Fed is doing in the United States. This resulted in the British pound to have a significant collapse relative to the US dollar. Additionally, the yield on long-term government bonds increased substantially. The increase in the yield of long-term government bonds due to their inverse relationship with prices had a significant impact when it comes to pensions as well as mortgages. In order to combat this undesired outcome in the bond markets, the Bank of England started buying a lot of these bonds. This to tip bond yields as well as increase price stability. The markets unfortunately viewed this as quantitative easing relative to quantitative tightening, thus boosting up the stock market today. So what does all this mean for the stock market? Well, basically, the rise in today's stock market is an unnatural phenomenon and is purely based on buffoonery that effectively occurred across the pond. The Fed chair has made it clear that they'll do whatever it takes in order to ensure price stability by controlling inflation, which will of course occur through rising rates. However, today's stock market rally should provide a glimpse of what may potentially happen should the Fed ever decide to slow their roll.